Hello, this is Accounting 251 Business Tax class. I'll be presenting today. My name is Ferdy Alfahora, presenting on Chapter 9, Partnership Formation and Operation. Today's lessons objectives are reporting on results of partnership operations, mainly the ordinary business income, identifying separately stated items, and reporting these separately stated items to partners. Now, in the book, there's a question as to whether partnerships can become a publicly traded company. So familiar with Carvana, and I don't know if any of you are familiar with Carvana. They sell used cars online. They're one of the biggest publicly traded companies that are partnership. Though they're not technically a partnership, the parent company is the one that's publicly traded. Um, the the way it was set up is that the LLC, which was the initial company, created a company that became the parent company, which only has 3 employees, the CEO, CFO, and the general counsel, which are also the members or partners of the LLC, right? And all the operations are handled in the LLC level. So there's per operating agreement, the LLC pays for all the expenses of the parent company, right? So that's kind of how the you could say that the LLC is indirectly a publicly traded company. Okay. So partnership is a flow-through business entity, which means that they don't actually file income tax returns because they don't pay the income tax. The taxes are paid through the partners. That's why it's called a flow-through, right? The business, the partnership, files a 1065, Form 1065 with a Schedule K. That is for informational return. It does not calculate the taxable income, right? The partners are the one who file the Schedule K1, and the figures or the dollar amounts as calculated in the Schedule K1 eventually will go to the partner's individual tax return if they file a 1040. Now, if the partner, like the Carvana, if one of the partners is a corporation, then those Schedule K1, those dollar amounts, those figures will be reported in their 1120, in their corporate tax returns. Right? So what governs the rules of partnership income? I just wanted to share that. The section, the Internal Revenue Code section, can be found in subchapter K, which is section 701 to 755. But mainly the main focus of this presentation is section 702, which is the separately stated items on the 1065 and Schedule K1. Okay, on the 702, you can actually say it shows in determining his income, each partner shall take into account separately his distributive share of the partnerships. And this talks about the gains and capital gains, charitable contributions, dividends. So those have to be separately calculated by the partnership for the partner. Okay. What are these separately stated items? In the book, in Exhibit 9-6, it gives you the common items of separately stated items. On the right here are the ones that I actually copied and pasted from the IRS website. So here I actually have more, but they actually cite the section 702 where you get all these separately stated items. Description: ordinary income, rental on real estates, gains and losses on exchange of capital assets, charitable contributions, dividends, and so on. Foreign taxes paid to foreign countries as well, right? So if a 1065 is just an informational, it's not really a tax returns, how many hours do you think it takes typically to fill out a normal 1065? Here's another fact from the IRS website. Typically, it takes 35 hours to fill out a 1065, right? Again, it's just an informational return, but it takes a lot of hours, right? And Schedule K1, which means that if you're preparing that 1065 for a partnership, you have to fill out or prepare the Schedule K1 for each partner as well. It takes about 9 hours or so. Let's just say 10 hours per Schedule K1. And if they have 10 partners, that's a lot of billable hours. So that this actually all translates to billable hours if you're working for a CPA firm. It's kind of good to know. Okay. So here I just kind of created a sample of what are the amounts that kind of create a ordinary business income, right? So it's similar to statement of income with individuals or corporate entities. You start with revenues, less cost of goods sold, less a bunch of deductions, and you come up with income. In partnership, it's called ordinary business income, right? These guaranteed payments for Adam and Bill is something that we'll cover in the next couple of slides. But these are what you would call separately stated items, right? And after you calculate the business income, the separately stated items are calculated down below, right? It's not actually a calculation. It's more of a determining what is the share per partner, right? So here, made-up company, ABC Partnership, Adam, Bill, and Carvana created a company, partnership, 30% for Adam and Bill and 40% interest for Carvana. Right. So in this scenario, there's a dividend income of $3,000, long-term capital gains of $4,000, interest income of $1,000, and the guaranteed payments for Adam and Bill. This is kind of how they are set up. So if you see here at the bottom where their partners' income, right, they're kind of close together, right, from $32,000 to $29,000 and $28,000, right? If you did not include the separately stated items in calculating a partner's income, then you would see that the business income, there are roughly $22,000 and $22,000 for Adam and Bill and $30,000. That's about a 10% gap. But in essence, if you include the separately stated items in the calculations, they're actually much closer, right? And that's why the calculation of separately stated items is separate from the partnership, even though it's the partnership that actually computes these amounts for the partners. Okay. So there's actually a question on the frequently asked questions on the IRS website. Are partners considered employees of a partnership, or are they considered self-employed? Partners in a partnership are considered to be self-employed, not employees, when performing services for the partnership. So they're not a W-2 employee, and they are not an independent contractor, so they do not get a 1099. They actually get a Schedule K1, right? And here too, right, the general partners must also include guaranteed payments as net earnings of part of their self-employment, right? If they're a limited partner, only guaranteed payments for services are considered part of the self-employment tax when they're calculating the self-employment tax. Okay, so there's a question in the text sample down here, and this actually just wants to test whether you know the difference between general partner and limited partner and how guaranteed payments and the distribution of their profit and loss interest factored in, right? So here, Stephen is a general partner because he has authority to bind the partnership into contracts. So therefore, he's a general partner. Okay. More on guaranteed payments and self-employment tax. Guaranteed payments are treated as ordinary income to partners, but they're expensed and capitalized by partnership. Shares of profit and loss are subject to self-employment tax for general partners because they're considered active participants, right? They're actively engaged in the business operation of a business. But for limited partner, they're more considered a investor. So the profit and loss is part of their investment income, right? It's not considered a self-employment, okay? However, guaranteed payments for services are always considered subject to self-employment tax, right? Always. Now, are there any guaranteed payments that is not service related? Certainly, right? Guaranteed payments could be used in the fringe benefits like health insurance, life insurance, tax reimbursement, or even reimbursement for tuition or anything like that. So those are all part of guaranteed payments, and they are not considered self-employment since they are not payments for services. Okay. So in addition to other separately stated items, or part of the or examples of separately stated items are business interest expense. So remember, business interest expense, it's subject to the limited to interest income plus 30% of adjustable taxable income, and the remaining balance is carried forward for corporation. In partnership, it's separately stated into partners, or it reduces their partnership. So those business interest expense is part of partners calculations, right? QBI, qualified business income, same thing, that 20%, the partnership has to calculate those for the partner. Does not include service related income and partnership income, investment income like capital gains, dividends. Those are not part of the QBI calculation, right? Net investment income for partners, right? Those are all your passive income like dividends, rent, interest income, basically any activity that does not involve a partner's engaging in. Like it's just pays for itself, so to speak, right? Allocation of partners' income or loss, right? The partnership agreement typically will be accepted by the IRS because they have very flexible rules. If partners agree, and 2, has substantial economic effect, and 3, the purpose is not tax reduction, right? It will be accepted by the IRS as long as it meets those guidelines, right? Built-in gains. I think the best way to kind of explain built-in gains is kind of show a quick example, right? So here A and Z form a partnership with 50% interest from A and Z. Z contributes land with a fair market value of 100 and a base of 20,000. 2 years later, the partnership sells the land for 130, right? So at the time of the contribution, there's already an 80,000 built-in gains, right? At the time of sale, there's 110. So how is this gain allocated to partners? Z has the built-in gains of 80,000, so he's going to get that. The remaining balance of 30,000, the difference between 110 and 80,000, will be shared between A and Z based on their respective interests, right? 15,000. So technically, Z will get 80,000 plus the 15,000, which is 95,000 altogether. Okay. So here's the sample of the Form 1065. As you can see, you have the income in the first group. And the second part is all the deductions. The guaranteed payments is one of the line items, right? And then you get with the business, ordinary business income, right? The next one is the Schedule K, right? Now Schedule K1, this lists all the partners' share, right? So you have to have so here are all the partners' separately stated items from the partnership's calculation, which will transfer into Schedule K1, which is the partner's return. And again, here you have all the yellow highlighted items that are separately stated items. Now, and this will eventually go to the schedule or the 1040 form of the tax return. Okay. So here I wanted to have differentiate the state rules, right? So all the federal rules, they don't tax partnership, but they do tax them in states. So look out for that. Okay. So in conclusion, the key takeaways, right? Calculate the partnership's ordinary business, identifying separately stated items, and reporting separate items to partners, right? I remember the partnership do not file or pay the tax. It's just informational. Thank you for watching.